Hi, everyone. I hope you're all doing well. I hope you're all hearing us well. Could I have a small thumbs up in the chat if everyone can hear us well, by any chance? All right. Thank you. We'll just be waiting max 2 minutes for everyone to be joining on time, and then we'll be starting. Thank you for waiting. All right, I think we can start. So, well, for those of you just joining us, welcome and thank you for coming. My name is Louis, and I've been working at Kaiko for a while now, and I'll be your host for today's webinar. And before letting our two speakers, Clara and Bediss, introduce themselves, I'll just give you a small rundown of how this is going to play out. So first, they'll do a small presentation, and then we'll open the Q&A. Know that you can ask questions at any time. It's on the bottom right of your screen in the little questions tab. So really ask anything you want. And know that you can also upvote other people's questions, and we'll be answering as many questions as possible, starting with the questions that have as many upvotes as possible. With that said, I guess I'll let Clara introduce herself and then Bediss. And just as an FYI, know that at the end of the webinar, we will be providing a recorded version of the entire event. So don't worry if you missed anything, you'll have it all as a recorded video. And with that said, Clara, the floor is yours.
Great. Thank you very much, Louis. It's great being here. My name is Clara. I'm the Director of Research at Kaiko, and Kaiko has been extensively covering the collapse of FTX, especially on the research side. So in case you saw, we included a lot of our coverage in the description of this webinar. So today I'll be talking a lot about the data that we found, and then I'll be joined by my colleague Bediss. So Bediss, feel free to introduce yourself.
Good evening, everyone. My name is Bediss. I'm leading product at Kaiko. So today, most of the FTX collapse will be covered by Clara. The reason why we wanted to do that both together is mainly for also the Q&A question, because we believe there will be a lot of questions around building. We try to showcase in the webinar solutions and how to avoid and be future-proof this kind of event in the future. So happy to be online and to answer any question.
Okay, so I think we can get going. So let's start the presentation now. Before we start, I wanted to give a brief overview of Kaiko. Bediss, can you? So Kaiko, in case you guys are unfamiliar with the brand, Kaiko is a data provider for crypto assets. We've been around since 2014, and today have four main business units. The first is our market data. We provide more than 100 exchanges. This is centralized and decentralized exchanges, tick level and aggregated data. We also have quantitative analytics, which is used to price and assess risk. We have a rates and indices offering, and then finally research. We have data-driven market analysis that is read by thousands of industry professionals. So you can learn more about Kaiko on our website, www.kaiko.com. But today, what we're here mostly to talk about is FTX's collapse, and specifically how investors and enterprises can better understand liquidity and risk data, and how that can sort of change how people understand liquidity and crypto assets in the post-FTX era. So let's first talk about what exactly happened. We're going to quickly go over the events leading up to the collapse. It all started with a cryptocurrency called FTT. This is what is called an exchange token. So the thing with FTT is there are many different exchange tokens issued by a range of cryptocurrency exchanges throughout the entire industry. But what happened with FTT is that it had a particularly high market capitalization while it had very little actual users. So on November 2nd, CoinDesk published an article where they examined the balance sheet of Alameda Research. Alameda was a trading firm that had very close ties to FTX. They were pretty much sister companies, and what we now know is that they had virtually no wall between the two. So CoinDesk found out that a significant portion of Alameda's balance sheet was actually held in FTT, this cryptocurrency created by their sister company, FTX. So this caused instant red flags, but it wasn't until the CEO of Binance tweeted that they will liquidate their holdings of FTT that people started to panic. So when Binance CEO tweeted this, everyone started withdrawing their assets from FTX because people assumed that if the price of FTT fell, if what the rumors were true, in that Alameda and both FTX had too much of FTT as either collateral or on their balance sheet, that this could actually pose a risk for the entire exchange, which actually ended up proving correct. So FTX had to halt withdrawals after a massive wave of withdrawals, and this ultimately triggered the complete collapse of the token FTT. Throughout this time, Binance announced that they were going to acquire FTX, and they backed out of the acquisition. And then finally, a few days later, FTX was forced to file for bankruptcy. I think actually today is a good time that we're doing this webinar because late last night, the CEO, the former CEO, SBF, was arrested in the Bahamas on wire fraud charges. And so it's actually a nice conclusion to the FTX saga, or actually it's probably just beginning. But a few days later, we're going back in time now. That's when the contagion started. So that's a brief summary of how FTX collapsed and how the contagion throughout the entire industry started. But what I really want to emphasize today is that FTT was a very illiquid token, but it wasn't just FTT. FTX and Alameda had many, many illiquid tokens on their balance sheet. So let's take a look at some of these tokens now. So the illiquid balance sheets, they came to light throughout the collapse of FTX. Right as FTX was searching for a savior to avoid bankruptcy, there was a leaked balance sheet which was acquired by the Financial Times. And on this balance sheet, it showed that FTX had liabilities of nearly $9 billion, but liquid assets of just 900 million. So what were all the other assets? It turns out that many cryptocurrencies that they were marked to market on their balance sheet, which is something that would never happen in traditional finance, were actually created by FTX themselves. To no one's surprise, FTX actually held a bunch of FTT on their balance sheet. They also held many altcoins that pretty much no one had ever heard of. So what Kaiko wanted to do is understand, let's say FTX wanted to liquidate all of their less liquid assets. How would that be possible? So what we did is we charted the market depth of these less liquid assets. And on the right, you'll see our market depth charts for two tokens. The first is one called SRM, Serum, and the second is called MAPS. On the balance sheet that was leaked, it turns out that FTX was claiming to hold nearly $2.2 billion worth of this token. Yet, when we charted the market depth, we saw that it was under $1 million worth across all exchanges. So how is it possible that FTX got away with valuing a cryptocurrency at $2.2 billion when the only market-wide liquidity for it was under $1 million? So it turns out there were dozens of assets that were similar. And this just shows a huge flaw in the industry when it comes to valuing illiquid assets. And so, Bediss, now let's talk a bit about how in traditional finance, funds avoid the problems that come with valuing illiquid assets.
At the end of the day, in traditional finance, when it comes to valuation, it is very closely related to both collateral management, when you have to issue loans on the back of collateral and assets, and fair value management. And a balance sheet, to some extent, is a combination of both. When you look at collateral management and you want to go into your lender in traditional finance and you want to get a loan based on an amount of collateral that you have, let's say, I don't know, 2 billion worth of XYZ stock, your lender, the first thing they're going to do is look at what portion of that collateral is actually liquid. And anything else they'll just ignore, because practically speaking, if you end up in default or you end up having a problem, the only way out for them will be to liquidate that collateral. So any collateral that is not liquid is actually worthless. And when it comes to practice, about valuation, there is a wide standard in traditional finance, but that is also being pushed in crypto, is asset categorization under Dodd-Frank or GAAP frameworks, which are also applicable in the EU. Assets are classified against level 1, level 2, level 3, based on their liquidity profile. Level 1 asset being extremely liquid are indeed eligible to be marked to market. When it comes to level 2 and level 3 assets, there are different models and different way of evaluating those assets, mark to matrix, relying on broker quotes or aggregated quotes, or level 3 assets, you're relying on pure modeling of pricing for very illiquid assets. Interestingly enough, back into 2018, a study was done when it comes to crypto assets, and most assets in crypto, if all of them, were categorized either as level 2 or level 3 assets. And in the level 2, you would find only the most liquid from a crypto standpoint assets as Bitcoin and Ethereum. And all the remaining assets would be level 3 assets. So at no point, if you follow the traditional finance standards when it comes to business practice, you would have ended up with such a situation.
Yeah, exactly. I think that's well said, is that liquid assets, it's something that in traditional finance, sure, you have many illiquid types of assets, but there's ways to manage that and ways to value it that differ from just doing a simple price times supply, which seems like what FTX and Alameda did. So now in the next part, we want to actually look at the data and teach you guys a bit on what these metrics are. How can you use data to assess a crypto asset's liquidity? So liquidity metrics in cryptocurrency markets are divided into, this is between centralized exchanges and decentralized exchanges. On centralized exchanges, a liquidity metric is used to understand the depth and volume for a crypto asset. It's actually very similar to what you would see in traditional finance. You have measures like market depth, the bid-ask spread, price slippage, and trade volume. Today, we are mostly going to focus on market depth, and what this refers to is simply the quantity of an asset on an order book. And a high measure for market depth means that you would get less price impact if you were to execute a large market order. So you want an asset to have a high measure for market depth. When it comes to decentralized exchanges, the similarity is liquidity pools, but we're not really going to focus too much on DEXs today. So let's give an example of market depth. Here I've charted the Bitcoin market depth since July. This is simply the total amount of Bitcoin on both BTC USD and Bitcoin Tether order books. So I think it's more than 20 separate order books that we looked at, and we took the sum of all Bitcoin within 2% of the mid price. So essentially, in simple terms, a higher measure for depth equals more liquid. So when we see the FTX Alameda collapse, we notice a huge drop in this depth. Why did this happen? This happened right as prices sort of were going crazy across all markets. There was a lot of uncertainty, specifically on centralized exchanges. Market makers were very wary to store their assets and continue market making on exchanges when they didn't know if they were to suffer the same problems that FTX did. So today through December, we actually see a continuation of this huge drop in liquidity across markets. It went from more than $250 million to just under $150 million. So that's a difference of about 100 million across all markets, which is quite significant considering that crypto markets as a whole still are not as liquid as what you would see in traditional finance. Now, in crypto, there has been, I think, a fundamental misunderstanding of what liquidity means. And this is because a measure called market capitalization has really been used as like the most, I would say, the dominant measure for the value of a crypto asset. You have websites that show the ranking of cryptocurrencies by their market capitalization. But unfortunately, it is very easy to manipulate a market cap for a token because it's simply the price times the supply. And so we actually now know that what FTX did was a lot of the cryptocurrencies that were on their balance sheet were simply created by the exchange or by Alameda Research. And so it was very easy for them to actually inflate the value of these cryptocurrencies through simple manipulations of market capitalization. So at Kaiko, what the research team wanted to know is how does the market capitalization of the top 30 cryptocurrencies measure versus its liquidity? What we did here is we ranked each market cap, each cryptocurrency by the market cap and also by the liquidity. So the liquidity ranking is between 1 and 28. We looked at 28 assets, and the lower the liquidity ranking, the more liquid it is. So as expected, we can see that Bitcoin has a market cap rank of 1 and a liquidity rank of 1. But as we go further down the list of market cap, we notice an interesting trend. We can see that not every cryptocurrency is as liquid as its market capitalization would indicate. And essentially what this proves is what we probably all knew all along, is that market capitalization is simply not a great metric in crypto markets. It doesn't tell you anything about the underlying liquidity and the ease at which you would be able to execute large market buy or sell orders, which would impact the price. And here's a bit more deep into how we actually calculated the liquidity ranking. We took the trade volume, the market depth, and the spread, and we ranked every single cryptocurrency here into these three categories, and then took a super ranking of all three. And we can see again, BTC ETH have the highest liquidity, the best liquidity rank. Shockingly, Dogecoin, actually, which is a meme coin, is ranked number 3. But then the further you go down the line, that's when things get a little more surprising. Tokens that have lower liquidity rankings or worse liquidity rankings aren't necessarily like the highest valued.
And previously, we talked about both marking to market and collateral management. And what Clara just did is completely debunking the logic of market cap driven analysis. And indeed, one can issue 1 million supply of token, and then suddenly a trade of $1 happens somewhere in an obscure exchange, and suddenly, woof, you're worth $1 billion. And the same kind of problem also exists with lending and borrowing lines and both CeFi and DeFi. On the CeFi side of things, and we'll come back later on the topic of contagion and so on, we've seen to what extent lines of credit collateralized, fully collateralized in crypto with questionable amounts and illiquid amounts rose up in the media and so on, but it's also the case for DeFi. And when you look at DeFi, so there was an event that happened on Aave and the Curve token that led to the protocol actually questioning the amount of token they have in some pools that are lent to the protocol against borrowing in very liquid stablecoin to then leverage on the market. And the very same insolvency can happen as well in DeFi, because assuming those lending in altcoins that are done on a lending pool against liquid stablecoin cannot be liquidated by the DeFi protocol, then you end up in the exact same situation where they hold a given amount of supply of those tokens, which is, by the way, also priced based on a marking to market by a pricing feed. But that amount in the pool is actually not something that can be liquidated, and probably, if you applied other models of valuation, worth a lot less than what is displayed. And the very same way you can debunk market cap as a metric, you could also fully debunk LTV, so total value locked, in the different lending pools, because of bad collateral practices and bad collateral valuation and absence of a liquidity criteria.
Yeah, I think it's interesting that like most people have thus far only like sort of thought of centralized and decentralized markets in isolation. But what we're seeing more and more instances of is that decentralized markets and decentralized protocols actually very much rely on centralized price feeds, and they do this through oracles. And so that's why some savvy traders, or many would consider bad actors, have exploited markets on illiquid centralized exchanges to essentially trigger liquidations in DeFi protocols. And so they're very much linked, which is why if you are a DeFi trader or engaging in any way with DeFi lending protocols, you really do need to understand the liquidity on a centralized exchange, because at the end of the day, this can really cause a liquidation and cause you to lose a lot of money due to manipulation. And so in the context of FTX, we've focused a lot about how the exchange collapsed, their poor balance sheet management, the liquidity problems. But as we now know, it's very much more than that. There's a lot of contagion happening now. Dozens of firms are affected. But good news is there are a lot of traditional risk metrics that can actually be used to avoid a similar event.
So if we look at the contagion phenomena that happened since November the 2nd, we're 1 month and a half-ish later, all of that follows waves and a domino effect. The collapse of FTX at the center immediately triggered impact on multiple businesses. Those impacts are of two natures: either pure holdings being freezed, so no longer access to that asset that actually ended up being used for another purpose and literally vanished in the Alameda hole, or the other way around, through lending, open line of credits that couldn't be satisfied, so pure default on illiquid collateral that was given back to the counterparts in exchange of a loan that is now defaulting. So that is the first layer of impact. And obviously, contagion being contagion, those actors end up themselves in default, or having to meet collateral requirement, or their counterpart having to liquidate collateral requirement that they cannot because of liquidity problems. So at the end of the day, all of that goes into a snowball effect. We've seen in traditional finance early on during the global financial crisis, the very same mechanic of contagion when you have a liquidity crunch in an ecosystem. And following that, a lot of effort was made to reconsider practices around collateral management, around structuring of products, around practices when it comes to collateral, to risk management, both at product issuance level, but also at counterpart management, risk management, supplier risk management, and so on and so forth. What we have been working on since more than a year now is actually bring to the crypto ecosystem the very same tool. It's not because it's a young industry that there are not similar concepts that can be transposed to crypto. When you look at shortfall management, what is happening now because of the bear market, and that's also the consequences of the Terra collapse and so on, that triggers a shortfall. But a shortfall is something, if you apply VAR models and so on, that you should account for by immobilizing cash to hedge against shortfall. But that and on a daily basis. But that is not a sound practice and something that is completely established in the crypto ecosystem. And all of those very risk management oriented practices that are now becoming completely common and standard in traditional finance must find their way in the crypto ecosystem to establish a business standard that will let the ecosystem grow in a sound and a proper fashion. And now that the whole industry is pivoting and looking forward to have these frameworks being implemented at scale, it's probably midterm, long term, an overall good news, because that will allow players to deploy capital with a sense of financial security, because those practices exist and contagion risk is limited. The second thing, and that is important, I saw a question on proof of reserve, is blockchain. Clara?
Yeah. So what now? I think so. What Bediss, I think, very well said is that traditional financial risk analytics is something that many in crypto have never used before or even understand. And in traditional finance, these are actually a regulatory obligation. And so we will certainly see the obligation that crypto investment firms have a certain percentage of capital on hand. And this is to avoid a similar black swan event. And that can be done with the simple tools such as value at risk, expected shortfall that everyone in traditional finance uses today. So far, we've talked about liquidity and risk analytics, but let's talk about the future. What's going to change? What has already changed? And when we were looking at the data this week, I noticed an interesting trend. It's that regulated exchanges today seem to have captured a small amount of market share following the collapse of FTX, whereas the offshore exchanges have stayed the same. So this is not to say that offshore exchanges are going to see a quick drop in market share. Binance is still by far dominant, but overall, regulated exchanges have seen a slight increase, which you can see in this chart.
And the second aspect, back to the proof of reserve question, is more blockchain, less crypto. So there is a lot of media and sayings, etc., to say blockchain yes, crypto no. There is no blockchain without crypto. Those come in tandem when you talk about public blockchain. Well, that being said, what we've seen in the last cycle of 2 to 3 years is that the underlying thesis and the underlying technology and the promises of the underlying system that can be built on blockchain-based market infrastructure went completely aside, at least if not fully, but just because of speculation and the hype around crypto and hyper financialization of the space. Now, there is a balance that needs to be brought back, and the move towards proof of reserves and Merkle trees and initiatives in that sense are actually initiatives to bring back blockchain in the game, including with centralized finance. So one could argue that proof of reserve is not enough because proof of reserve doesn't tell you exactly the proof of accountability and liability. But at the end of the day, we are back into bridging what happens on the crypto side of things and the underlying technology on which it is built and that it leveraged and the whole underlying thesis. So on the one hand, yes, regulation is about an enforced standard. At the end of the day, what matters is business standards that need to be established. And the second thing is to focus a little bit more on blockchain and a little bit less on crypto.
All right, thank you to you both, Bediss and Clara. So Now we're entering the Q&A part of the webinar. Thank you to everyone who posted a bunch of questions. It's great. We'll be answering them by order of the number of likes or upvotes that they have, starting with Anastasia's one. And please note that you can you can still ask any question that you want. Just do it in the questions tab at the bottom right of your screen. Now, starting with Anastasia's question, I will let either Bediss or Clara, whichever wants to take this.
Yeah, I think this is what we talked a lot about when looking at the liquidity metrics. So, like, if I'm an investor and let's say I'm investing in 10 cryptocurrencies, I want to understand that in the event of a huge market collapse, how quickly would I be able to liquidate these crypto assets at the best price possible? So that's what we mean by liquidity, is can I get the price that I expect if I were to liquidate my assets? So if I were managing this portfolio, I would want to understand total market depth. And also I would want to simulate price slippage. So this is data that is actually quite heavy and can be a bit difficult to come across. Kaiko has some of these liquidity metrics. We actually have all instruments that trade on all cryptocurrency exchanges. So we actually have the most comprehensive liquidity data that exists today. But if I were an investor, I would definitely use the market depth metric, but also trade volume, which is it's not a direct indicator of liquidity because it can actually be manipulated, but it is closely correlated to liquidity. So to summarize, market depth and trade volume.
And one last thing also that could be worth mentioning on this case is composition of the portfolios. Clara spent a little bit of time debunking the market cap metric. A lot of portfolios, even indices, claim to be blue chip indices, rely on top X, top 5, top 10, top whatever logic of building a portfolio in terms of investable universe. And that is not true either. Including liquidity criteria in the composition of the portfolio before even starting to manage it will be more and more important.
Thank you to you both. Moving on to Lucas's question now. How can investors know which exchanges are reliable, and is proof of reserves enough?
Yeah, I'll let Bediss answer this.
Yeah, so I'll also, by the way, take on the point of there is an element about DAO noting exchanges and companies. So it's no secret that we have our own exchange ranking, and there are a couple of others available out there. And definitely, one can either build a DAO to note exchanges or build consensus over those multiple ratings on top of it to have a consensual one. But at the end of the day, again, one needs not to fall into tricks. Because the reason why Moody's and such companies exist in traditional finance is because in those ratings, you need to account for elements that are not necessarily publicly available and so on and so forth. So yes, proof of reserve is one element of that. We don't know today to what extent exchanges are leveraged against one another or against a lender. We don't know about their credit lines. We don't know about what are the different operations and intertwined operations between some having trading bots or other elements within their activities. So in terms of exchange ranking and so on, those are proxies. They are useful proxies. They are not perfect, and then they can never be deemed perfect. What will be also important is to look at the vertical integration at an exchange. And if you look at TradFi, an exchange is not like you don't have bank accounts on an exchange. You can trade, but you cannot hold assets. And at the end of the day, you have other parties, whether it's custodians, whether it is CCPs for settlement and so on happening. I'm not saying that way of articulating a microstructure and a market infrastructure is necessarily the best way. But what is important is to not have judging parties, to have checks and balances in place.
All right, thank you, Bediss. All right, moving on to Vitiss's question. Would deposit insurance make sense in the crypto ecosystem?
I think there have been several attempts to do this, but it's very hard when like many DeFi traders are using so many different protocols and trading very rapidly. So it's very hard to like incentivize people to take the time to do insurance, and also to make sure the insurance covers all the various different protocols that exist. So I know that there have been attempts, but I'm not sure how successful they have been.
And insurance is but a back uh, uh, a fillet, a net on which you can fall. It's a fallback mechanism. What you need is proper risk management. When we talk about value at risk and shortfall, that is on a daily basis, how much cash should I provision because of my position and because of historical movements in the market, and I will reassess that cash amount on a daily basis to account for it. And that is pure cash that I stash next to my portfolio and that I immobilize to account for risk. And that is not an insurance, it's just proper sound portfolio management. And that cash management component needs to find its way in crypto, including at pro traders, because the space is heavily retail driven still.
Thank you, Bediss. All right, moving on to Flavius's question. What is the best way to incentivize institutional borrowers that have on-chain and off-chain activity to show all liabilities before taking on a loan?
I'm not fully sure about the best ways to incentivize. I do know that that's sort of the core problem of crypto is the ideal is to have everything happen on-chain, in which case you can verify everything. But in reality, the vast majority of market activity happens on centralized exchanges where that completely lack transparency. And also typically it's sort of like the traders themselves don't want people to know what they're doing on these exchanges. So it's very hard to sort of match the incentives from those who are the lenders and those who are the traders. But maybe Bediss, you have a better understanding.
I mean, liabilities to some extent are not necessarily negative per se. Liabilities are open lines of financial leverage you need to operate. You need, for instance, I don't know, those liabilities not necessarily to be disclosed because you're entering an M&A operations, because you're having a financial investment because of X, Y, and Z. Liabilities are not negative per se. And if you disclose them, then you're going to have a problem because there is a lot of things that you can't do any longer because you can't just do everything on the open space sometimes, just also because of other regulatory requirements and because everything cannot be displayed upfront. So public markets, for instance, require even them a logic of sensitive disclosure that happens on a quarterly basis and so on. So liabilities need to be disclosed, yes, and there is a reporting that must be done and so on, but displaying everything and so on is not necessarily a sound business practice either. What is important, though, in terms of incentivization, is for everyone to realize that if you do not display sound business practices, audits, and so on, then that will cast doubt. And I think the conclusion on incentivization, maybe you're not going to disclose your liabilities and so on, but you need to disclose an enforced trail of being audited, of going through business practices that make sure that neutral third parties are actually looking at you and signing off the way you operate.
Thank you, Bediss. All right, moving on to Josh's question, which I think has been a question that's been thrown around a lot lately. Are you seeing a shift towards DeFi and self-custody?
I think that's one of the dominant narratives post FTX, is the shift to self-custody, especially when it comes to traders storing their assets on exchanges. Actually, over the past day, there have been a lot of rumors circulating around Binance, and they've actually seen the largest outflows of cryptocurrency from the exchange, I think, in history. And so this is, of course, going to self-custody or more institutional custodians. And I think there's still a lot of wariness around the safety of storing assets on centralized exchanges, rightfully so post FTX. So we certainly will see a huge increase in the number of traders that know how to do self-custody and that prefer to do this rather than storing on exchanges. As for DeFi, this is another narrative. I mean, ideally, crypto will be more DeFi focused. Today, though, the majority of activity is still happening on centralized exchanges. Today, DeFi and decentralized exchanges are dominated pretty much by Uniswap V3 and Curve. These are the two largest decentralized exchanges. They've certainly seen an increase in trade volume, but it's not that significant relative to what we're seeing on centralized markets.
I think that was very clear. All right, I'll move on to Eloan's question. How much percentage of your cryptocurrency collateral value will a bank loan you in dollars?
Bediss, any idea?
I can't tell you about how much they'll take, and I don't know the policies that are established there. However, what we can tell you, and that's public knowledge, if you look at the last BIS prudential regime, is that banks should be currently the logic is to say they could have an exposure of 1% of their to crypto. So 1% means that in terms of prop capital and so on, only 1% of their capital could be expressed in crypto and to accept collateral in crypto to issue loans or do their credit activities. But that doesn't give you the answer, the full answer to your question, which is okay. But how are they going to value that? If they stick to their TradFi practice, a common one, for instance, is to take only as collateral something that they know can liquidate, which is 5% of daily traded volume on a given asset at the max. So depends on the practices, depends on the banks, depend on the jurisdictions, depend on the prudential regime that will be agreed upon. But Bitcoin-backed loans and bank-issued loans have emerged, so it's a developing space.
Thank you, Bediss. All right, moving on to Akli's question on Tether. Is Tether's commercial papers the new FTT? Is CoinDesk working on this way bigger topic as well?
I don't think we know what CoinDesk is specifically working on at this moment. I mean, there's been speculation around Tether for years and years, and many like, I guess, predictions for Tether's ultimate demise have come and passed, and nothing has really happened so far. They certainly are not transparent. We don't have a full understanding of what is actually backing their reserves. But I think they've definitely made better efforts over the past year to publish at least some more high-level documents pertaining to their reserves. And so I think it's too much to say it's the new FTT. FTT was essentially backed by nothing. It was just a cryptocurrency created by FTX, whereas Tether is a stable coin that has received real US dollars and that is valued one-to-one. To this day, has almost always maintained its peg.
And one thing worth noticing is that technically Tether's commercial papers are treasury papers, so they are TradFi assets. The amount and so on is something else, but they're TradFi assets. FTT, like to Clara's point, is a fake token, essentially. So at no point Tether's commercial papers can become a new FTT. That's not going to happen. Now, the logic of backing and so on is another topic, but technically they just cannot become the next FTT.
Very clear. Moving on to Connor's question. Will financial regulation impact trading on centralized exchanges?
I think regulation historically has, I mean, that goes without saying, extremely slow. I think we're going to see the biggest shift in terms of consumer behavior, that's going to be first, and then we're going to see regulation. And we're already seeing that. We're already seeing consumers and the actual individual traders are paying a lot closer attention to the venues that they're using. And they're doing this without regulation. Since FTX collapsed, I mean, there's been nothing substantial that has been passed. That takes months, if not years, to get comprehensive crypto regulation. And it likely won't happen for a very long time. So it's actually going to be driven by the consumer if we do see an impact on centralized exchanges, at least in the near future.
And to complement that on the institutional space, the very same exact phenomena is already happening. We know because we sell data from various exchanges and so on that we have ongoing discussions with multiple actors on both buy and sell side, looking at considering shifting their exchanges if they've withdrawn their assets, if they haven't, if they're looking to redeploy their crypto operations, and looking at reassessing what exchange or what venue and so on. So there is literally a redeployment across the industry that is happening right now to say what trading venue should be deemed proved enough. So that's one. And the second thing, when it comes to financial regulation impact, it's going to have a trading impact in terms of volumes and so on. But the first thing is going to be a logic of checks and balances in the role of the centralized exchanges. Currently, centralized exchanges are doing in one go the custody, the accounts, the trading, the settlements, and so on as a single all-in-one package. Now, what will happen probably is that financial regulation will look at segregating the different roles, maybe within the same entity and within the same exchange, but making sure that those different activities are segregated to make sure that FTX doesn't happen again.
All right, thank you. Moving on to the next question. This is now some more technical questions on lending pools. Do you think the delegator model for lending pools is robust enough?
I don't have a strong opinion on this.
I think DeFi has been extremely creative in trying to push for algorithmical logics and dynamics to mitigate risk. But at some point, whether it is delegator models, whether it is a consensual approach in the decentralization of network and activity, whether it is lending pools, trading, and so on, it reaches a limit in the sense that, and that's a very data topic, by the way, it reaches a limit because, okay, but if at some point you don't have a logic embedded in the risk model of the protocol of the native protocol to account for liquidity risk and another model of pricing for illiquid collateral, then you can deploy whatever delegator model and whatever dynamic, whatever consensus, whatever algorithmic approach. Well, it is just wrong valuation, wrong data, and illiquid stuff that is being used and leveraged to do something else. So, yes, all of the decentralization is welcome, but the second problem is around maths and data.
All right, thank you, Bediss. Moving on, how can we store crypto offline, which is not supported by the cold wallet?
Bediss?
I'm not sure to understand the question.
Yes, how can we? I guess this would be more of a technical question, which is very remotely related to data. Or risk
I
management.
mean, if we go to, so because there is the problem of saying, okay, internet connection, and how do I use my crypto if I don't have an internet connection? And if that is the question behind this, indeed, various technologies are being explored to be able to make payments and to use wallets and to use, for instance, your Bitcoin via non-internet related networks. It's already being tested and proof of concept validated that you can transfer Bitcoins through GPRS networks, which is the network that's used to send text like SMS. So there are technical breakthrough being done to remove the internet dependency to make payments in Bitcoin, if you look at Bitcoin in particular. And probably that can be leveraged to build on altcoins and other blockchain-based cryptos in the future. Because first and foremost, we need not to come back to the root, which is all about making finance available and affordable for everyone, including the underbanked, people with no bank account, and indeed not necessarily an internet connection.
All right, thank you, Bediss. We've already been going on for more than 45 minutes. Maybe we can do one last question. There we go. What is your take on implementing the Sarbanes-Oxley regulations from TradFi to the cryptocurrency companies? So again, on the reporting regulations.
Back to regulation. So there are two things. So yes, reporting to regulation is going to be important if it is adapted to crypto. Again, and to crypto and to globally blockchain enabled finance and market infrastructure. What I mean is that whether it is Sarbanes-Oxley, whether it is MiFID in Europe and the various RTS-based stuff, at the end of the day, there are hypotheses that were made when those regulations were written. TradFi is a closed environment. So TradFi, because it is a closed environment, that means that from a regulator standpoint, you can regulate the space by regulating entry points and exit points, so gateways and a couple of actors in the whole ecosystem represented by a web. In decentralized frameworks, there is an opportunity to operate in an embedded supervision framework, whereby you don't necessarily regulate an entity because it's code. So you can give licenses, yes, for you to deploy code that will end up being used to as a venue and a trading venue, but that's just licensing. When it comes to regulating, that assumes that the regulator will be able to look at the data, look at the activity that is happening on the decentralized exchange, for instance, and based out of that, identify, I don't know, market manipulation patterns. And because they identify that, they can trace that to the wallet that actually made the attack and enforce the regulation at market participant level. And that's activity regulation model versus entity regulation model. And that is an extremely hot topic currently on the regulatory front. There is an RFP that was issued in Europe by FISMA to talk about and to test embedded regulation. It is exactly the same topic that was pushed by former CFTC chairman Giancarlo when it comes to activity regulation and embedded supervision. So reporting to regulator will be
I think Bediss's connection might have cut off there for a bit. Well, I think we've had the time to answer actually every question here, and we're really out of time. So I'm sorry if you guys had any more questions. Do feel free to reach out to our research department, which Clara is heading, if you have any more questions, of course. But other than that, I think we're going to wrap this up. So thank you so much, everyone, for coming, for asking all these brilliant questions. And remember that this webinar is entirely recorded, so we'll be sure to follow up with a recording of that if you want to share it with anyone if you found it interesting. And yes, thank you very much for coming.
Thank you all.